Hello. Welcome to YetiZen Speaks event on the top 3 term sheet mistakes founders make. And with me is Stephanie Zeppa from Shepherd Mullen. Stephanie, hello. How are you?
Hi, Sana. I'm happy to be here. Thanks. How are you doing?
I'm doing wonderful. So why don't you take us into what you'll be talking about today?
Sure. So I'm going to talk about 3 mistakes that founders might make negotiating a term sheet for an early stage venture round. So what we're looking at here is really something that could come up in a Series C to Series A, Series B, and some of these issues, as we'll see, will haunt the company through all the future rounds of financing as well. So,
Haunt the companies and haunt the founders, right? Loss of control, loss of wealth.
Yes, yes. I mean, I have to, caveat all of this by the fact that, I think that founders are always working their hardest to, do the best for the company, their teams, and themselves. And so, I think it's more about getting the right information to avoid mistakes versus, making mistakes per se, because there's certainly, challenges in any kind of term sheet negotiation.
Yep. For sure. Okay, well, let's go into it.
Sure. So the first thing I'm going to talk about is liquidation preferences, and one thing that goes along with them, participation rights. And the reason why we're talking about that is because liquidation preferences and the rights around that determine how the proceeds of any kind of exit or liquidity event are allocated among the shareholders. So sometimes you hear people talk about a waterfall or an allocation at the time of a sale. Well, that document or spreadsheet or allocation of price is going to be based upon the rights, preferences, and privileges of the preferred and the common, and primarily their liquidation preferences. And in particular, whether or not those preferred have participation rights. And it sounds innocuous enough, but participation rights can really dramatically impact the amount of money a founder can get. So
okay, before you go on, just so I'm clear, so you're saying that if I'm assuming at the time of exit there's going to be 30%, 40% preferred shares, that may not necessarily mean that if a company sells for 5 million, 40% of that will be going to the VC. It might actually be more than 40%.
That's exactly right. And that is going to be based upon whether or not that VC stock is participating preferred, and in fact if it's fully participating or it participates up to a cap. And so what I'm trying to show here on the next slide is a couple of different scenarios for distributions of sale proceeds, and this is only with a single investor. Keep in mind that if you start offering this type of right to an investor early, all the subsequent investors are going to want it too. So as you can imagine, if you had 2 or 3 rounds of financing, that there would be a lot more dotted lines on this chart. But just so we can kind of focus on how this works visually, and then we can talk a little bit more about some of the different scenarios where this comes up. I have 2 lines on this. One is a dotted dark line to indicate the Series A preferred distribution amounts. And then I've got a more lighter, it's a little hard, it's supposed to be like a thick white line, but it looks probably a little pixelated, that's going to represent the founder. And so we have 3 examples. We have a fully participating preferred right, participating with a 3 times cap, and a non-participating preferred. And so I just want to start on figure 1C to just illustrate this a little bit. If this is a non-participating preferred, as you see, when there's a sale with a price of anywhere between 0 and 400 million, the preferred investors are going to make more than the common, right? Because they're going to get their liquidation preference, which is the initial investment, plus some return. But once the sale goes over the $400 million mark, because they don't get any additional rights to participate in the proceeds with the common, they're actually going to get effectively the same pro rata return as the common. So you're from a common percentage protection perspective, non-participating is certainly the best. And you can see in figure 1A, which is a fully participating preferred, the preferred gets its initial return and then continues to basically make an incrementally greater amount on a per share basis over the course of any future sale amount, all the way up to, this figure goes through $2 million. But as you can see, there's no point at which the preferred in that scenario is not making more than the common, and effectively, your common amount is going to get reduced, because they're part of the common amount that would be available in the non-participating scenario is getting paid to the preferred investors. And then the participating with a cap, you can see the preferred get a return greater than, they get their original return, they participate for a while, and then once they've reached that cap, they go back and they're aligned with the common. So the common do suffer some loss of their capital from a liquidation price amount perspective, but if the value of the deal is high enough, and in this case 1.6 million to 2 million, then they're going to be realigned. So those are a couple of different options, and I think the biggest risk here is that if we're talking about early stage financing, and an investor comes in and asks for it, and the founder gives it, every future investor is going to want it too. I have yet, in all of my transactions over 15 years, seen investors, and they really have a lot of leverage, because
I lost you a little bit in terms of voice. There was a lag. So if you could start again from the part where you said, I've yet in my last 15 years.
Oh, I haven't seen an investor, a future round investor, not want at least the same rights as any earlier rounds investors. So if you start, for example, at like a Series C level, giving out participation rights, you can be sure that every next investor is going to want that. And, sometimes you do it because that's the way you need to negotiate the deal to bring the money in. But, you and I are really talking about making sure that founders have enough information so they avoid that as a mistake. And I have a client in that situation right now. They did a fairly friendly seed round. They didn't necessarily appreciate the impact of offering a participating preferred right. And they did one without a cap, so it's, the worst case scenario. And now they're bringing on their A round, and their A investor wants separate participation rights. So as you can see, it's a compound problem.
So if you choose to do it, that's fine, but be aware of what you're choosing to do is your sort of takeaway, and pay attention to participation rights and understand what you're getting into.
Yeah, absolutely. And I think there's a lot of disalignment of the interest between the founder and the investor, the greater the amount of participation there is. Because what happens in a lot of cases is, as you can see from these various curves, there's a deal value over which, one group of investor may be more impacted than another group of investor. And so, you could have misalignment of incentive to negotiate an exit, which is also challenging, right? You don't really, you not only do you not want to lose part of your, hard-earned, founder equity from a liquidation perspective, you also want to make sure that everybody's aligned in terms of growth and plans for the company. And so, you can see that after a certain amount, like in the participating with a cap, after a certain purchase price, it doesn't make a difference. The investor is not going to get the same additional return. So they're not going to be as incentivized necessarily to try to go for a deal, at the higher range, because it's not going to, sure, they're going to get more money back, but it's not going to be, they might make sufficient return at a lower price because of the participation rate for them to just be happy to take whatever's available.
And also the sort of converse can happen, that a founder may want to exit earlier, but it doesn't make sense for the VC, because they feel if they hold on and exit it at a higher price, they can actually get even more than a one-to-one return due to their participation rates.
Yeah, that's exactly right. So, like you said, be aware of what, it sounds innocuous enough, in terms of participating preferred, but I think it's really important to understand the economics, and, founders should always sort of think through just how the waterfall would work what amount of money would be the additional benefit an investor would get if they're participating. And then I think additionally, it's really important to realize that, you know, every investor is going to want this. So it's a slippery slope, right? You give it to one, you're going to have to give it to everybody.
Got it. And then the next mistake. Trump there.
Donald, I mean, he probably thinks there's lots of mistakes. So the other thing that I think is, from an economic terms perspective, that can often be a gotcha is, you know, ending up negotiating a full ratchet anti-dilution provision instead of a weighted average anti-dilution provision. And so, you know, anti-dilution is one of the most technical parts in a term sheet. It's usually several dense paragraphs of formula that are not that easy to read and relatively unimportant at the time of financing, but can certainly have a long-term impact. So the most typical type of anti-dilution protection is called weighted average anti-dilution protection. And I would say, you know, I haven't seen many term sheets that had something more aggressive than that for, you know, a good 4 or 5 years, because I think generally the market has been, you know, mostly company favorable and getting more competitive. But certainly during like bad economic times, and, you know, right after the .com time and you know, in the late 2000s, we saw a lot of requests for a full ratchet anti-dilution protection. And this is effectively a downside risk protection mechanism for investors. So what it does as a practical matter is it takes the conversion price of the preferred stock, which usually is a 1-for-1 basis, prior to a down round, meaning raising money at a price lower than the last round, and adjusting it downward to a conversion price that roughly is equal to the price per share paid in the dilutive financing. And so in other words, like if you were going to convert, you know, 10 shares on a 1-for-1 basis, and then there's a subsequent down round and it's at 80 cents a share, you would in a weighted average situation, you wouldn't go straight down to 80 cents a share. You would go to something in between, maybe, you know, 90 cents or 83 cents, so that you wouldn't have as much of a anti-dilution adjustment in the preferred. And so when I'm talking about anti-dilution, you know, what we're thinking about is if an investor buys in at 25% of the company, and there's a down round, then their 25% is going to be reduced, because the new investor is going to get a greater percentage of the company at a lower price. The anti-dilution protection allows them to adjust the conversion of their percentage of their stock, so their percentage stays relatively stabilized, notwithstanding the fact that the company raised more money at a lower price. And so a greater percentage of the company is eaten up by the preferred, and the founder and other common holders don't get any of those protections. I think that's a really important point, Sana, is that any kind of anti-dilution protection is a negotiated right, and common stock doesn't have it. So this is something, and that's, I'm not suggesting that that's unusual, that's pretty standard. But what I'm suggesting is that this idea of sort of being able to preserve your percentage by using anti-dilution really is a preferred right. And so to the extent a company can kind of constrain that to the least dilutive type of protection, they're better off. And full ratchet just means full 1-for-1 adjustment. So like I said, if you sell at $1 and you do a down round at 50 cents a share, that dollar stock becomes basically 2 shares of 50-cent stock. And as you can imagine, if that happens enough times, the percentage of the preferred grows and the common just dwindles.
Got it. And our last and final mistake.
Sure. And this is not really an economic mistake, but this is certainly a mistake that can have economic ramifications. And the reason why I say that is because it's a risk of losing your seat at the board table. And you know, I've seen in many instances founders, for a lot of different reasons, right? Founders aren't always the best CEO of a company at the different life cycles, right? And so there can be opportunities for a founder to, you know, still have a voice in the company's direction without being the CEO. But in order for the founder to do that, he has to make sure that the board composition terms, and the term, any term sheet will specifically address this, provide for a designee by the common. And so your typical Series A term sheet will have a right to say that a couple of the seats are designated by the preferred. There'll be a spot for the CEO, and then there may be maybe an independent director, maybe not. If there's not a specific spot designated for the common stock, in other words, a majority of the common stock get to elect a director, then it's possible that the current founder, who's both a majority stockholder and the current CEO, could lose his or her spot at the board if there was a situation where they were no longer CEO but still a majority stockholder. And that means they're not going to have a seat at the table for all the really big commercial decisions. They're not going to be able to impact financing, at least early on, at least. And they might also even be in a situation where they really don't have any opportunity to understand, or think through the rationale for when a company gets sold, which can, really, talking about all the timing points earlier is obviously a really big issue. And what's interesting is, like, we have so many big companies today that have, raised money and are, maybe they're in an IPO timetable, maybe they're not, but they've been around for a long time. I mean, take Twitter, for example. They've had several CEO changes. And those types of companies, if the people who own a majority of the company don't have a right to have a seat at the board, and the company's going to have maybe a longer than a 2 or 3 year life cycle, then they're really going to lose out on the opportunity to participate in large corporate decisions.
And so it's important for all of the members who actually have common stock that this part be taken care of. So founders, as well as any employees that may have common stock, to be able to sort of protect the interests of the common stock.
That's right. And I think, there's a lot of different ways that can come into play depending on the different transaction. But the way that you guarantee it is by making sure that it's specifically designated in the charter documents and in the voting agreement, and that all gets negotiated in the term sheet. So, if you're not thinking about that up front, you could lose out on it really quickly.
Got it. Okay. So that's our 3 mistakes, right, Stephanie?
Yep.
Awesome. So if folks have questions about this, or in general about fundraising, and want to talk to you and find out if you can sort of guide them through this process of fundraising and be their legal partner, where can they reach you?
Well, I have up my contact information for.
Wonderful.
And I'm happy to take any questions. It's always very, no 2 situations are ever the same. And I think, it's very important to try to get advice from, a partner in a firm that has a lot of experience. And we've been, supporting emerging growth companies, their investors, and, companies in the game industry for many years. So, happy to chat with anyone who has questions and, give some feedback anytime.
Awesome. Wonderful. And your firm is one of the top legal firms in the game industry, right?
That's right. Yeah, we have some representative clients up here. These are actually some of the companies that these are a little bit older clients, but we work with a lot of other companies today: Activision, Blizzard, PlayStation, Kabam, just to name a few. And so we've been in the video game space for a lot longer than I've been practicing law, and it's an ever evolving field. And there's a lot of companies at different stages that are interested in it. So we certainly can, from an industry perspective, have the point of view both of like big publishers and console providers, as well as smaller independent studios and venture-backed companies.
Wonderful. Well, thank you so much for your time today, Stephanie. And I learned a lot. I'm pretty sure our audience has learned a lot as well. And we look forward to seeing you again at another topic for YetiZen Speaks Online.
Wonderful. Thanks so much.
Take care. Bye-bye.
Bye.